the goods being exported is not exempt from indirect tax, in this context, VAT. The price charge is much higher in the country of destination, and then it puts it at a disadvantage. Does that bring in more revenue to the government? I would say no.
Hello, everyone, and welcome to another discussion on the Africa Asia platform. So, tonight we're having a discussion on tax, and it's been a while since we've discussed matters tax and Africa. And tonight we'll be speaking about how tax affects African goods and services in the global market. And tonight we have a guest. Very nice to have someone to speak about this tax topic with. Darling Stone, I'll let you introduce yourself and then we'll get started.
Darlingston Tallery. I'm the Commissioner for Taxes at the Liberia Revenue Authority here in Liberia. My job is to take care of all inland revenue, administer and collect all inland revenue for the government of Liberia. Yeah, so in a nutshell, that's who I am and that's what I do.
Okay. Thanks, Darling Stone, and it's good to have you tonight. I also practice tax in Kenya, so I'm an advocate of the High Court of Kenya and I practice tax law. So this discussion, I hope, is going to be quite enriching to anyone who listens to it. So, and we've divided the discussion where we'll speak about how tax affects services, and then we go to how tax affects goods, both goods and services coming from Africa to the global market, and then how that impacts the African economies. So, Darling Stone, I'll let you speak first, share your thoughts. You could start with either services or goods, or whichever side you'd want to start from.
Yeah, so I will first start with service, right? On the global front, with the context of Africa, services are being moved across the digital economy. It's bulletless, we don't see it, so the volume of service is ever increasing, especially in those regions that have a lot of young people and that whose economic impact, economic well-being is being driven mainly by services through the internet. Africa being no exception to what is happening, especially so in South Africa, in Nigeria, where the issue of user participation, the issue of how services are being marketed across. And then it comes down to how these services, if they are physically being provided in a particular country, normally it will be governed by that country domestic tax law. But then the intricate part has to do with cross-border transaction. It goes across the border, and then it becomes more harder. It becomes tougher as to how to tax it because it's right now in the international arena. The OECD has been championing, right, the issue of international tax in the international tax arena. ATAF, the African Tax Administration Forum, has been very vocal as well in how to tax these services, where taxing rights should be excited. Has it driven the price of goods and services up? I would say it depends. It depends. It depends on how that service is being taxed. To some large extent, those services are not taxed in the market jurisdiction. Market jurisdiction being Africa. In this context, that mainly Africa uses the services, but they are being taxed in jurisdictions that are resident of companies that are providing the services to Africa. So now the paradigm should be shifted to the market jurisdiction to excite or to exercise its taxing right over those services that are being provided to Africa. As an experience, I would say that some of the services are not being overtaxed, or they are not being regularly taxed as they should be because of no physical presence in a particular country. If we go over to good is quite different because physically we see it. So they come through the borders. They either come through the land or the sea border. that one you can see, and that one you can exercise, or you can exercise your taxing rights. So at the port of entry, so if it's at the port of Mombasa in Kenya, or it's at the free port of Monrovia in Liberia, now the government of Kenya or the government of Liberia can exact taxes through the imposition of custom duties and other taxes, VAT, for instance, excise tax in the context of whether it's an alcoholic or non-alcoholic good. Then a particular government can exact its taxing rights because it moves physically across the border. So that's a tricky difference between the taxation of service vis-a-vis the taxation of good. One is physical, you can see it, but the other, because you cannot see it and the movement of it is so massive, so it becomes difficult to tax.
Yes, and the comments you make are quite interesting, especially with the use of services and especially digital services, and among the youth population, which is quite high in Africa. And I also wanted to add some points on the services, but this is in the case of like services which are being provided, especially digital services being provided from Africa. And most times someone would think Africa is always importing, but there has been an increase with like innovations coming from Africa, that people are trying to innovate and come up with solutions that they can sell to the global market. So or you'll find something like someone has developed a phone app from Kenya, which may be downloaded like from the Play Store or from the Android, the Google Play Store or the Apple Store. And now what has been happening, for instance, if I may use Kenya, is that so VAT is being charged on services. But now what has been happening is that when you're exporting a service, which now means in that case you're in Kenya, and it could be that maybe you're offering the service to someone, let's say in Canada, or you're offering whatever it is that they are downloading in Canada, and then Kenya wants to impose VAT on that when you're exporting. Ideally, under the OECD rules, when you're exporting, you should not charge VAT. So that now the goods, when they're leaving your country, they should be charged in that country where they're being consumed, which is what Darlingstone is saying. For instance, like if you're bringing services into Kenya, Kenya ideally should be the one that should tax the person who is consuming that service in Kenya. So, but then on the other hand, if Kenya is selling something going outside Kenya, it should not be subject to VAT, which is value added tax, which are the goods and service tax in Kenya. But now something like has been happening with different countries is that there are different ways you go around it. You could decide when someone is selling the goods out of the country, you want to tax it, or to apply the rules like which is a bit more detailed for someone who doesn't practice taxes. Like if you exempt those goods from tax, then it means that the cost increases. So these are the considerations when you're saying that we will tax this economy, especially domestically. You also need to consider how that's going to impact when someone wants to create like an app and it's downloadable everywhere in the world, so that you can enable the people domestically to be able to offer these solutions in a way that's affordable, so that someone is able to pick a Kenyan product and the same way they would pick a product from China, for instance. If the Kenyan product is very highly priced because of tax, then maybe it might impact their competition. And especially because now it's very borderless. So when someone is going to like the Apple Store, if it's functioning, the app is functioning, you really don't care where the developer is. And sometimes you don't even know where the developer is. And then also on the goods, the difference which has been highlighted about like the goods and the services is that you see the services could be virtual. Someone is downloading things, someone is offering trainings, someone is offering like if you go to Instagram, someone is offering workout sessions, and someone is just sends you a downloadable link. It doesn't matter where you are, someone can download that information on that link. But then now on the goods, you actually either take goods physically from Kenya, take them to Liberia. so now in that case is that when you're looking at it like from the side of Kenya sending goods to Liberia, is to ask how can Kenya make sure that when its goods go to Liberia, of course subject to other factors, that they are not so expensive because of the taxes that have been levied in Kenya, that they cannot compete in the Liberia market. Of course, there's all the rules that will apply, because you don't want again to go and kill the industries in Liberia, because the goods coming from Kenya are so subsidized that they're destroying the industries there. So these are some of the considerations, which is just general overview of what you look at on like how taxes either impact goods that are being consumed locally or goods that are being sold. Darlingstone, I'll let you like add more to this discussion.
One interesting point you raised concerning the imposition of taxes on export, right? VAT. I think it's very critical that countries, like you right there alluded to the fact that the OECD says that at the point of origin it should not be taxed VAT, but at the point of destination it should be taxed. I think it's the point in the right direction, because it makes your product more competitive. If a country imposes VAT or indirect taxes on export, what it does is that it puts the local industry in a particular country at a disadvantage in terms of competition. All right. So if you're exporting from Kenya to, say, Uganda or to Liberia with a VAT charge, and then at the point of destination is also charged, by the time it gets on the market in Liberia, if the price is say 10 United States dollars, it might go to as high as 50 United States dollars. And if that particular product in Liberia at the same competitive edge, it might be sold, say, for $20. So then you put the product from Kenya at a disadvantage. So most countries, policy-wise, they make that informed policy decision to say, hey, VAT or indirect taxes on export is either zero rated or it's just completely exempt from VAT. And I think it's very critical that countries consider that to put the economy at the competitive edge. And on the issue of services, right? Especially when in order to encourage an R&D means research and development. What countries do in terms of the development of R&D, say you talk about say a software being developed by a young person in Kenya. Some countries will just say, okay, I gave you a tax break, right? I gave you a tax break, or I gave you these kind of incentive to develop the R&D, because once you develop it and you start to export it, it brings in more tax revenue to the particular country. So from the development stage, you give it some level of incentive that when it comes to exploitation of that particular R&D, then revenue is generated. So I think such policies should be considered by African countries in terms of what can they do to grow innovation, right? In Africa, innovation that you give in tax incentive, tax break in terms of services that a particular industry or particular person wants to develop, that will, in the medium to long term, bring in more revenue into the country. So I think we need to, African governments, especially the Ministry of Finance, need to look into that direction. I know that many countries are finding it very abusive in terms of the level of incentive they gave out. It's being abused right now, but I think we need to muster the courage and ensure that the incentive that we give is targeted and towards growing the economy and towards exporting the product from a particular country, like the instance you gave about, say, the software being developed in Kenya. I think it's very critical.
Yes, Darlingstone, I agree with what you're saying, and especially when, like, I'll give the example of Kenya. What has been happening is that So the law was changed on, like, when you're exporting a service from Kenya. What happens is that you see, to produce something, even if it's a service, for you to be able to offer it, you have to incur cost. And this cost, especially from a VAT side, what happens is, let's say I'm offering consultancy services to a company in Mauritius. So what happens in Kenya is that I'll need office space, and office space I'll be charged VAT on it. I'll need pens, I'll need paper, I'll need all these things. So what Kenya has done is that they're saying that all the VAT that you incur to be able to offer this product for export, you cannot claim it back. So what has happened is that the cost, what I'm going to charge someone who I'm offering the consultancy services to in Mauritius, must include an element of the cost that I incurred, which include the tax that I was charged, so that I can offer this service. So what has ended up happening is that, and this is affecting especially like flower exporters who need certain services done locally, like to consolidate the flowers and to do all these things, services that you're offering. So now what happens is that when the products go to the market, is that you end up being quite highly priced, because as a business you're trying to recover the cost. But there's quite a lot, and also what you've spoken about. So Darlingstone and myself, we've done ADIT, so the Advanced Diploma in International Tax, and I remember like one of the options that I was doing was on China tax, and one of the incentives that China has really been trying to push is for the research and development in the technology side. And as you can see, because the tech industry and the tech economy, the digital economy in China is like one of the really, like, it's really high in numbers right now in China. Like, you see products like TikTok coming from China. You see like even the 5G, it's Huawei offering it. So there's such a huge incentive that's given from a tax perspective for the highly digitalized businesses in China. So you find like if you're in the technology sector in China, or if you offer an investment of a certain percentage to a startup that is in the digital economy, you get a certain incentive. So these are some of the things which we will speak a bit more on, like how tax impacts investment decisions and how governments, especially within Africa, can make use of such things. So ideally, I know it's discouraged, because as has been highlighted, that people take advantage of those incentives as well, because you can't set up for a short period of time, you may not deliver on the objective, you may just create a product, whether it's a digital platform, but then not host it in Kenya, transfer it to the Netherlands, yet used all the incentives that were being given in Kenya. So, but these are some of the considerations to take into account. Darlingstone, I'll let you possibly comment on why these considerations are important for African economies. Why is it important that someone actually takes into account these kinds of things, whether it's the government departments, whether it's the finance sectors, especially in this era of both trading goods and services, so that you can improve the economy? Why is, like, considering what implications that your rules, whether it's incentives that you're giving, or it's the indirect taxes that you're imposing on your export, how does that actually impact your economy? Why is it an important consideration?
Well, so Christine, like I mentioned, right? I think it puts the economy of a particular country at a disadvantage in terms of its export. So if the goods being exported is not exempt from indirect tax, in this context VAT, the price charge is much higher in the country of destination, and then it puts it at a disadvantage. Does that bring in more revenue to the government? I would say no. That's why I said that giving of incentives need to be targeted. It needs to be well managed. It needs to be well monitored, right? If you are targeting, say, the flower industry in Kenya, what is the policy objective? what is it that the government wants to achieve when an incentive is given to the flower industry? Does it want to boost its balance of trade? Does it want to boost the revenue generated from the sector? Does it want to increase the number of employment? If those are policy objectives of the government, and then tax incentives are given, then I would say yes. Then it's targeted. Then those targets can be measured, right? Are more revenue coming to the government? Are more people being employed? Are the goods, are the flower industry, say in Zambia or in the western in the west, are they being more competitive in terms of sales, right? So if all of these questions are yes, the answers to these questions are yes, then we can say, okay, our policy objectives of giving these incentives are being met because revenue are being generated, employment is taking place in the sector. The prices of flowers on the international market are competitive enough that they are being sold. So my point of emphasis is that giving of incentive to lure in revenue should be targeted. Another thing I think African countries should be concerned of, quickly I want to mention, is the issue of the people taking advantage by abusing these incentives. Some of them lead to huge frauds that dip into the revenue envelope of the national government. There are massive corruption, massive collusion that these incentives could be exposed to. So that's why in our space, we normally say that when an incentive is issued, right, it should be with a policy direction. So I've quite just a while ago mentioned 3 policy objectives that a country could say that's the reason we want to give these incentives. Because the economy, especially after COVID, where most African governments are struggling to meet the basic social needs of their people, I think it's critical to think and rethink on strategies of boosting revenue and some ways that we can boost revenue through taxation is the issuance of these incentives to incentivize innovations, to incentivize growth in the economy that will grow and bring in more tax revenue. I think that once it's guided, once it's targeted, once the safeguards are in place to fight corruption, to fight fraud, to fight leakages, I think it can be a major boost to the African economy and bring in more revenue.
Okay, thanks for that, Darlingstone. And I think the thing to mention though, and someone listening to this to caution about also on the incentives is that within the same regional community, for instance, within ECOWAS or within the East Africa community, you find that Tanzania decides to reduce its taxes in a certain sector to attract investment. Then what happens is that Uganda feels like because we are within the same region, we want to attract the same investment, we will even go lower than Tanzania in the investment that we are giving, which leads to a situation called race to the bottom, where each country is trying to go as low as they can. And then at the end, what happens is that you end up, all of you losing. Because now what investors do is that they hop from one country to the other and then to the other, and then they use that as a negotiating tool where you tell someone, the Kenya tax rules are so good, we would rather go set up in Kenya unless you give us this thing, and they're telling this to you, the Uganda authorities. Of course, there are many factors that should impact the tax decisions of like where you invest or what you do, but tax definitely is normally one of them. So that's the other situation that could arise out of it. And right now in the world, because of the global value chains, is that you can get your chains of, let's say I am assembling a phone. I could source the labor to assemble it from one country and then get someone to market it from another country. I can get someone who can do the legal contracts in another country, because you can segregate your functions across the world in different places. Now, what has happened is that most businesses now, and then also there's remote working. So people now, you don't need to be in Kenya to do work for a Kenyan company. you could be in Liberia and be working for a Kenyan company, especially when you're doing this remote work. So what has ended up also, again, from a tax perspective, is that you consider as a business, why should I pay this amount of like employment taxes in Kenya when I could pack all my stuff in Nigeria and have them be doing work for the Kenyan companies? So why this is important to take into account all these things is that, one, this can have a direct effect on your employment rates in a country. If, for instance, you're not, someone decides that we will be employing all our staff working for Kenya from India, we are outsourcing all our call centers to India, it means that there's less work for Kenyan staff or for Ghana staff. And then also decisions like, if we decide we are moving all our assembly functions to this country, then it impacts the jobs. So it's not only on the amount of tax that the government is collecting. It's also that it trickles down to the industries and the employment rates and how you're doing, not only in your trade, in the global market, but whether your industry survive. So like the example I gave for Kenya, where like business people are not able to claim the taxes that they incurred to produce the services they're exporting to the international market. What then that means is that how much can the domestic industry sustain itself if you're not able to export, especially when right now, as I've said, the value chains globally are so integrated. So if you're not able to tap in and be able to export your service, or no one wants to buy services from Kenya because of the cost of it, then not only does it impact the revenue that's being collected, it cuts Kenya off the global value chains because no one will be wanting to get services from Kenya. So these are so the discussion about tax is not just looking at just the revenue collection, but it has a huge impact on the global perspective of how much value you're getting or you're contributing to the global value chains, and therefore as a return you're earning from it, and also like your employment rates, it will affect your industries and all these points. Darlingstone, I'll let you make your closing remarks and then we will end the discussion for tonight. We can pick up the discussion further on investments and how taxes might impact investments.
Thank you, Christine. But I think the recent development on the international tax arena, particularly the OECD Pillar 1 and Pillar 2 initiative, particularly Pillar 2 that has to do with the minimum tax rule. I mean, there are sectors that are carved out of those rules, but I think with the introduction of the minimum tax rule, it will ensure that it will not eradicate it, but it will minimize the race to the bottom in terms of where an industry can go. I mean, where investment is concerned, because now once that particular industry is not carved out of the rule, they will be subject to the minimum tax rule. All right. So once your effective tax rate is below the minimum tax, it is topped up and taxed accordingly. So I think that's a good way to discourage the movement of industries owing to these aggressive tax plannings that these multinationals do that impact the economy of our countries, right? So I think that, I mean, African countries need to pay keen attention to that. Aside from taxation, like you mentioned, it impacts the growth of employment. It impacts innovation. So yeah, I agree. In my closing comments, I think that African countries need to pay more attention to research to determine the impact of taxation, whether it is growing the economy, what level of so tax to GDP ratio, how is it, and the kind of revenue that is being generated, and then it will inform a particular government to say how they can design the tax policy to grow the economy or to stabilize it post-COVID pandemic. I think is key. Research in the impact of taxation, research in the impact of investment is key, right? That will inform decision, tax policy decision, how to carve it out. Because, like you said, that an industry can move from Kenya to Zambia because of the tax rate. But if the minimum tax is 15%, there will be no incentive to move from Kenya to Uganda or to Zambia, or say you move as far as away to Liberia. All right. So yeah, I mean, it's a very interesting topic. We are so passionate about taxation. We could go on and on talking about the impact of it. But I think I look forward to our next section. In talking about tax and the effect it has on the African economy, whether it's on the African economy at the global level or individual African countries. I think it's very key in this either a post-COVID pandemic or some countries are in between it right now. I think it's key that we keep talking about the impact of it. Yes, Christine.
Okay, thanks a lot, Darlington, for that. In fact, we should discuss a bit more about the global minimum tax and its effect on Africa. And it's interesting that not all African countries even agreed to sign on the OECD Pillar 1, Pillar 2 solution. Like Kenya didn't sign, Nigeria didn't sign.
Isn't it Kenya and Nigeria did not sign?
Yeah, quite interesting, to be honest.
Yeah, but all the countries. But ATAF has been pushing. For all of us has been saying that the rules are kind of quite complex. The rules need to be simplified. But like you say, it's a discussion. It's a whole discussion for another day. We could take it as a very critical topic as well.
Yeah, and especially to try and break it down now that we have taken the time to at least look at the rules to break it down for someone looking for such information. But thanks a lot, Darlington, for coming by and having this discussion. We'll pick up the discussion on this in the next weeks. Anyone listening to this, please leave your comments and let us know what your thoughts are on this topic. And you could also consider coming to the platform and sharing your ideas on these topics. For tonight, thank you for listening, and it's goodbye from us.